Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include: what are state regulators up to? My interview with Figure's Michael Tannenbaum on stablecoins, the latest happenings at Figure, and product proliferation in the mortgage industry as a result of borrower and investor demand. And in the capital markets, there's a lot going on in this shortened week. Do you know that Figure is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days? Figure has hundreds of partners in the banking, credit union, home improvement, and, of course, IMB space, embedding their technology. Lenders give your borrowers an experience they will rave about, and you can learn more at figure.com. Whether it is weekly, monthly, or at every conference, experts are discussing compliance, regulatory changes, and how different governments view regulating residential lending and servicing. In terms of a broad scope, lenders should realize that the Trump administration has not abandoned protecting consumers. The status is more nuanced than that. Talk from politicians slashing the Consumer Finance Protection Bureau's budget continues, and it seems that 1,500 employees are still on some kind of leave. But the CFPB carries on prosecuting cases and attending to instances where consumers are wronged. The things that the CFPB is looking at include debt relief, lending to consumers, lending to members of the armed forces, and deceptive acts against students and the elderly. Colony Ridge, which is a fair lending case based on deceptive marketing to minorities and predatory lending, is still active and involves deceptive marketing. The residential lending industry wants a fair CFPB director and administration, pursuing clear-cut violations and preferably not letting politics determine when consumers are harmed. Lenders sometimes ask, why can't they just... Changes to a bureau like the CFPB can take a long time. The proposed rulemaking and comment periods can take many months, if not years. And unfortunately for lenders, it is very unlikely that the CFPB staff still actively employed have not worked with borrowers or processed and funded a loan. Therefore, the knowledge of our industry and borrower behavior is lacking. And with the CFPB gutted, writing new rules or changing old ones is all but impossible unless we have what we have. So, lenders and vendors should be very well versed in existing rules and regulations. But not so fast. Many state regulators are reminding mortgage companies that they still are the primary regulators, but have also come to the conclusion that they have to be responsible for writing and enforcing rules, possibly adjusting nationwide statutes. A portion of this is because independent mortgage banks and other lenders are licensed at the state level. Many states have their own mini CFPBs, mini RESPAs, or what have you, and they will pursue any potential violations. Colorado has tried to address artificial intelligence, Massachusetts, junk fees. Ohio has gone after UWM over deceptive advertising, which allegedly led consumers to believe that UWM-approved brokers are the best way to obtain financing. And prior to trigger lead action in Congress, Idaho, Utah, and Arkansas addressed abusive trigger leads. State regulators at the NMLS Policy Summit continually reminded the audience that their main job has not changed, and they have teams of examiners out there now looking at their licensees. State regulators are worried about the very large or mega non-bank entities in mortgage and concerned that they are appropriately supervising this new level of entity. They're looking at the process to see if they need to adjust their practice and policy and how they regulate at a larger and nationwide level. For today's interview, I wanted to welcome back to the show Figure's Michael Tannenbaum to discuss stablecoins, the latest happenings at Figure, and product proliferation in the mortgage industry as a result of borrower and investor demand. He's CEO of Figure and has nearly 20 years of experience in financial technology and financial services. Prior to Figure, he was COO at Brex, where he helped scale the company from a 3-person startup in 2017 to a global entity with more than 1,200 employees. And he also served as Chief Financial Officer and Chief Business Officer at the company. Before that, he was Chief Revenue Officer at SoFi, where he played a key role in the company's leadership and actually led the company's mortgage business during his tenure. I said, Michael, let's talk what's going on at Figure, products in the mortgage space. You said, no, let's do stablecoins first. So we'll start with stablecoin, and then maybe we'll close with some of those other things. It might be good to provide a little background because the average age in the mortgage industry is around 60. So You might know what a stable coin is. I might faint like I know like a what a stable coin is, but I had to Google it. So it's a type of
Yeah.
cryptocurrency designed to hold a steady value. And I guess it's there's
Yeah.
dollars held in reserve for every stable coin or something like that. But it's basically a stable digital asset for payments and trading. I'm hoping you can elaborate on that and tie it into the mortgage industry.
Yeah. Yeah. I would just think of it as like a digital dollar. So there's the fact that it's stable, just like a dollar is stable, except it can move instantly and it can operate within smart contracts, which, without getting into too much jargon, just means that in a bilateral transaction between two parties, the stablecoin might only be released at the same time as the loan is funded instantly. So you could think about an example of where you might want to use stablecoin is you pledged a bunch of loans to a warehouse line, and that pledge doesn't necessarily happen at the same time as the wire is received. So someone is, quote, on the hook for a bit, and the wire may, come after the loans or vice versa. And whereas a stable coin, the technology behind it could work almost like two revolving doors, where you think about like there's money in one, and sorry to use an example of like a hostage, but there's money in one and the hostage is in the other, and they both turn. So that kind of like they happen at the same time.
Yeah.
So stablecoin, it can allow atomic settlement like I just talked about, but it also can just be real time. It can move in, not just in the ACH and wire windows, which close, can move over the weekend. It can move in fractions. So it's just a more flexible money movement tool. And I think that it has a lot of interesting applications in financial services. And mortgage is a place where money's moving around a lot. So I thought we should talk a bit about stablecoin and where it might apply in mortgage, and what it might mean for the mortgage industry.
Well, you led yourself into the next question, and that's, can you talk about specific use cases for mortgage? Obviously, the way you explained it, it makes sense why it's good for, the future of mortgage, but I'm wondering how Figure sees specific use cases for it.
Yeah, so for Figure, we focus a lot on both the embedding our technology in other mortgage companies, but we also bring capital markets to those originators, that guaranteed takeout that we provide. And so on the back end, which maybe people in the mortgage space don't necessarily know, there's a lot that we do in terms of innovation in the capital markets. And so we do see like warehouse line funding as something that's very realistic, and we're starting to use stablecoin to do that. I think other areas you could think about this is very interesting, but when you have stablecoin in money movement, what you also have is a certified record of all payment activity. And so if you imagine that all mortgage loans were serviced in stablecoin, meaning the payments were collected in stablecoin, you would actually have cohort default rates and prepayment rates. You would know those automatically. And so when you were trying to, say, buy a pool of mortgages, you mainly care about the default rate and the prepayment rate. And you would kind of know that upfront. And so it would reduce diligence in pools of loans being traded. So I see the opportunities mostly in the capital market side of mortgage. I know there's a lot of attention, like stablecoins are most used today broadly in like international money movement, where it's a lower cost and effective way to move money, especially in emerging markets. But I don't see that as applicable to the US mortgage market. But I do see capital markets as a place where it could be used.
And I agree with you that the capital markets is a perfect use case for it when it comes to, moving along the blockchain sort of thing, not having to transfer stacks of paperwork and all that. I'm thinking philosophically, though, do you view it more as this fills a gaping need, or it's a if we build it, they will come type of thing?
I mean, that's always been a little bit of the challenge with crypto. I think, except for Figure, where we have used the blockchain to generate real value both on the origination side. Many originators that use Figure, they're probably aware that we put the loans on a blockchain, but they won't necessarily interact with it directly, or some care about it and some don't. But what we do is when we put the attributes of the loan on a blockchain, we we reduce the amount of third party review that needs to happen, because people verify and trust the process that we do. And so as a result, those attributes are put on the loan on the blockchain once, and then if there was ever any changes to that, there would be a record of it. And so over time, what it's done is it's reduced QC, quality control and third-party review for Figure, I think by like 80% and over 90% when you actually look at the cost. So we definitely have seen that. And what's interesting is we've been able to do that and still be AAA. Our most recent securitization was rated AAA by S&P. So we've kind of been able to combine real world use cases of blockchain with actual economic value and do that with the support of rating agencies.
I hate to be reductive like this, but imagine you're speaking to my dad about this, who's in his mid 60s and he doesn't quite get why we need this, that sort of thing.
Great guy.
He's a great guy. I love him.
Yeah.
What's the greatest rationale you could provide for why the industry needs to move in this direction?
Yeah, so now we're talking about blockchain more broadly versus stablecoin specifically.
Sure. Yeah.
Stablecoin is a tool of blockchain.
Yep.
I think cost of mortgage has gone up to $12,000 per loan to originate a loan, and everybody knows how often mortgages move throughout the system and are bought and sold and warehoused and then securitized. And when all that happens, each new party and each new owner does their own independent verification of everything that the loan, all the attributes. And that's obviously inefficient. And blockchain is a very simple way, it's very simple to understand. If I could completely have full transparency into what those loan attributes were upfront, and maybe have someone review it once and then see if anything was ever modified from that review, I could sort of draft off that. So in a way, I mean, blockchain, I mean, you could look at the FICO ecosystem, you could look at Visa and MasterCard, any sort of standard setting thing, even Fannie Mae and Freddie Mac themselves, right? Anybody who's setting standards across a variety of participants is kind of an early version of that. And then with blockchain is just adding technology on top of that so you can actually verify it yourself rather than just trusting FICO because they've been doing it, or trusting Fannie or Freddie because they've been doing it for so long and they're backed by the government. So it's kind of the same concept, same with Visa and MasterCard, right? It's like these standard setters that work across multiple people, but this is now making it verifiable by technology, which is one of the reasons why Figure has been able to become such a standard setter across 153 partners that we have in a very short amount of time.
You took the words out of my mouth. I was going to say Figure has quickly become a standard setter. Maybe I'll switch my verbiage and say Figure in a lot of ways, and much of this is to your credit, has become kind of the darling of the mortgage space. I hear it being talked about all the time at conferences when I'm traveling around. I hear your name, hear Mr. Cagney's name, and it's cool to see, both because as many listeners know, I know both you on a personal level, but also because it's filling such a need for the mortgage industry and what borrowers are demanding out there, and those sorts of things. Can you talk about kind of the latest happenings at Figure, what's been going on with y'all, bring people up to speed?
Yeah, sure. Well, first of all, it's nice of you to say that, Robbie, and you know that we love you too.
A lot
But
of, lot of love in this interview.
yes, but yeah, a couple updates from us. I think, I mentioned already, but we did receive an S&P AAA rating on our most recent securitization. We had historically been AAA from Kroll since 2023, but obviously, S&P, that's a new level of rating because it's one of the quote majors alongside Moody's and Fitch.
Mhm.
And so what that does is it lowers, our cost of funding, which we then pass on to our partners in terms of the rates as well as ultimately the borrower. So I think that's a really exciting thing for us, and it's definitely the first S&P rating of any kind of blockchain assets. So big deal from our perspective. From Figure, we have been busy in the first lien space. It's something you and I have talked a bit about, but we are Figure as of recently has the ability to pay off not only debts like personal loans and credit cards, but also actually secured debts. So HELOCs, first mortgages. And what that does is a lot of people are starting to use the Figure HELOC as a replacement for a traditional cash out refi or even a rate in term if the rates are high, because, and especially in the smaller balance loans, if you think about $12,000 to produce a mortgage, say $100,000 mortgage, that's 12 points, right? That's obviously not going to work. Whereas for Figure, we do a loan in about $1,000. And so for our partners, they are starting to use us to refinance and do cash out refinances in the smaller balance, say like $100,000, $150,000 loan balances. So that's a really big growth area for us and something that we think provides a lot of value.
I'm going to ask another philosophical question here. How do you see the mortgage industry needing to respond to kind of the demands of the modern consumer? And obviously, Figure did a great job filling one of those needs. But in general, we're seeing Fannie and Freddie kind of recede for, and then that might not be the proper words for it, but they become less competitive in a lot of ways. And there's been the
Yeah,
proliferation of the non-QM space, which
right.
there's a ton of demand for those type of products. And I think we'll continue to see a trend in that direction. How do you see the modern mortgage lender evolving to meet the needs of borrowers out there?
Yeah, I mean, look, I 100% agree, and Figure would broadly be considered non-QM as well. So I do not think that Fannie and Freddie have kept up with the needs of the consumer, and the growth of non-QM is clearly a testament to that. I think part of that is, what does Figure do differently? Well, we combine the technology and the capital markets. So we're sort of a combination of Ellie Mae plus DU, right? Plus Fannie Mae. And I know DU is owned by Fannie Mae, but so we're sort of providing the eligibility criteria and the technology. And so what that allows us to do is respond more easily in a unified way to the needs of the consumer. Whereas, say, Fannie may be doing something, but that's not necessarily what Ellie Mae is doing, which is, what the capital markets are demanding. And so you've seen Fannie Mae, it still obviously adds a ton of value in the ecosystem, but I think as home prices have gone higher, the cost to originate a mortgage has gone higher. We clearly have, and rates have gone higher. Something needs to give. And I think Figure is trying to fill that void and do loans in a much less expensive way, which just opens up greenfield opportunities for our partners and for borrowers.
And if is there anything you can tease about what's on the horizon for Figure? Exciting things coming up the rest of the year?
We see our opportunity set as very broad, not just second lien. I talked about how much we're doing in the first lien side of things as well. And we see our technology as continuing to be useful across a variety of mortgage cases, not just where we play today. So, we look at the growth in investor properties and single family rentals for sure. We look at the broader non-QM space and, people that are business owners and, is basically anywhere where Fannie Mae is not serving people as well. I think the traditional Fannie Mae kind of $500,000 purchase mortgage is broadly working with the rates that they have, and what, where the treasuries are. I think though, when you start to get into smaller balances, more unique borrower types, more unique borrower employment, those are opportunities for Figure to innovate where the agency ecosystem, not just the agencies themselves, isn't.
Always exciting to hear what's happening at Figure, both, like I said, from a personal perspective, because I want you all to succeed, but also for people out there listening, because it's certainly helping drive the industry forward. So thank you very much for the time, as always.
All right. Thank you, sir.
Bonds finished last week with some selling, but nowhere near enough to keep yields throughout the yield curve from closing the week below the levels where they started. That's good news for mortgage rates. What could potentially push rates higher? Well, there are plenty of tariff-related inflation worries. President Trump on Friday said that the U.S. had ended its talks with Canada due to its 400% tariff on dairy products and digital services tax. Uncertainty surrounding the inflationary impact of tariffs has solidified expectations that the Federal Reserve is unlikely to move rates until at least the September 17th FOMC meeting, unless upcoming data presents a compelling case for earlier action. More on that in a second. Sure, lower rates would goose the economy, but it would also make it easier for the government to pay off its debt. Broader macro forces are also shaping rate expectations. Easing geopolitical tensions and falling oil prices have reduced inflationary fears, supporting Treasury demand. At the same time, weakening consumer fundamentals, such as the lowest personal consumption since the second quarter of 2020 and falling real incomes, point to emerging cracks in the economy. As the Fed maintains a cautious posture, the markets are pricing in only a 20% chance of a July rate cut, with most expecting action in September. Upcoming data, including CPI and Q2 GDP, will be important in determining whether rate cuts are delayed further or pulled forward. For now, the market remains balanced between hopes for easing and the need for clearer signals of economic deterioration. Treasury yields remain near the lower end of their recent range as investors brace for this week's wave of high-impact economic data culminating in Thursday's jobs report. Chair Powell has underscored the importance of summer data, particularly the 3 inflation prints due before September, compared to just one prior to the July 30th meeting. The market is looking for signs of resilience or deterioration in key labor indicators. In this context, the upcoming ISM manufacturing and services reports, ADP employment data, and especially the non-farm payrolls release are key for shaping the near-term monetary policy outlook. In terms of last week's data, new home sales fell to a seasonally adjusted annual rate of 623,000 in May, nearly 14% below April's 722,000 annual pace. Inventory is currently at 9.8 months, and the median sales price is $426,600, roughly 3% above the May 2024 price of $414,300. Rising existing home inventory is slowing price appreciation and putting pressure on new home prices. Consumer spending declined 0.3% in May, and spending from the third estimate of the first quarter GDP was revised significantly lower. The pullback in May spending suggests consumers were spending cautiously rather than reversing a pre-tariff spending bump from earlier in the year. Economists remain concerned that a period of stagflation could still occur in the second half of the year. Last week's data points toward flattening growth as consumers become less willing to accept today's prices, which is preventing some businesses from passing through increased costs due to tariffs. The expectation is that at some point businesses will have to pass on higher costs or accept thinner margins to maintain sales. Markets this week are focused on the aforementioned June payrolls report due out Thursday, which is expected to show a modest 110,000 job gain as investors weigh the potential for early Fed rate cuts. Even slight surprises in labor market data have recently driven sharp moves in yields, with last month's modest upside surprise triggering a Treasury sell-off despite downward revisions in previous months. Although softening labor trends, like the highest jobless claims in a survey week since mid-2023, are reinforcing market expectations for weaker data, the ADP report, despite its poor correlation with private payrolls, is anticipated to rebound from last month's weak print. A combination of a disappointing jobs report and a tame CPI reading could bring rate cuts back into play for July, especially as unemployment has climbed steadily for 4 months, hitting 4.24% in May, with forecasts pointing to another rise in June. Today's economic calendar consists of Chicago PMI for June, remarks from Atlanta Fed President Bostic and Chicago Fed President Goolsbee, and Dallas Fed manufacturing for June. Over the remainder of the week, ISM manufacturing, construction spending, JOLTS, layoffs, and ADP employment, the June job report, ISM services, international trade. Do you like my inflection points? And factory orders will all hit the tape. Markets will get a break from coupon supply, though the Treasury will announce the mini refunding details on Thursday. Markets are closed on Friday for Independence Day, which is my personal favorite day of the year. Set off a firework for me. We began the week with agency MBS prices better than Friday's close by about an eighth. The 2-year yielding 3.72 and the 10-year yielding 4.25 after closing last week at 4.29%. Let's wrap up with a joke and some housekeeping. What do they call the 4th of July in nursing homes? Independence Day. Thanks again to Figure, which is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days. Figure has hundreds of partners in the banking, credit union, home improvement, and of course IMB space embedding their technology, giving borrowers an experience they'll rave about. Learn more at Figure.